So, as we continue to see growth in the economy, more groups moving into the office, we are going to continue to drive a stronger recovery in office leasing activity. So, we're expecting 10% year over year growth in leasing moving into 2025.
Hello and welcome to the REIT Report. I'm your host, Sarah Borgs from Quito. Research from JLL into the performance of the US office market in the third quarter of 2024 suggests that the tide might be turning for this core property sector. Here to talk about those findings is Jacob Rowden, Senior Manager for US Office Research at JLL. Jacob, welcome to the podcast.
Thanks, Sarah. Thanks for having me.
Jacob, how would you describe the state of the US office market today, and what are some of the key dynamics shaping your outlook?
So, really, since the outset of the pandemic, I would describe the office market as highly bifurcated, with vacancy that's been largely concentrated in lower quality or obsolete buildings. But within the last year, we're starting to see a top-down recovery that's now beginning to spill over more broadly. So some of the things that are feeding into that are we've seen this steady growth in office demand over the past 2 years that's translated into growing leasing volume over that time period. We're also seeing that among these leases being signed, there's a lot less downsizing activity on the market. Earlier in the pandemic, tenants were cutting their footprints pretty substantially in some cases, and that's now starting to normalize as more folks are in the office and they're realizing they need to hold on to more of that space. You're also seeing that trend play out through less additions that are going onto the sublease market. So generally, you're seeing less space cutting as that demand is accelerating. And we've seen a very significant shift in our supply pipeline over the past 2 to 3 years. So as rates have increased, we've seen new construction pretty much come to a halt for the office sector. And you're also seeing a record volume of office inventory being removed for conversions or redevelopments to other property types. So that's really started to change the supply side of the equation and push us into an environment where overall office inventory is starting to decline, which is helping us to reach this important inflection point overall, where now availability rates are starting to decline for the US office market as well. And that's something that hasn't been true for about 5 years now, even a little bit before the pandemic, because we had so much new construction volume that was delivering at that time. And then if you look out over the short to medium term, there's a lot of promising indicators on the horizon. Obviously, there are significant global risks with the macroeconomy, especially related to geopolitical developments. But outside of that, you're seeing a lot of strong growth projected over the next few years, especially in the labor market as rates start to come in a little bit. And then we're seeing a continued push to get employees back into the office. Even though we really reached a stable point earlier in this year where the majority of private employers had created hybrid attendance policies, you're still seeing some groups increase those requirements or increase the enforcement that's going on with those policies. So there's still momentum to be had there, which will continue to support that office recovery. So a lot of positive indicators that are really accelerating over the past 12 months that are pushing us into the next cycle as we begin here.
And Jacob, are you seeing consistency across office markets in terms of performance and outlook, or are certain regions performing better and standing out to you?
There's generally some consistency. There is kind of a national story that's playing out in most markets to some degree or another, but there are some definite variations that are playing out in some different pockets of the country. So especially if you look at the last 2 years or so, really since the rate hikes began, there was a more pronounced impact on cyclical industries, especially technology and biotech, so the life science market. So you see that areas that have a very strong concentration of that industry type have been more impacted in the past year. Of course, the greatest example of this is the Bay Area. The San Francisco market has seen the largest swings in vacancy of any market in the country since the pandemic began. They had roughly 5% vacancy in the office market in 2019. That's now moved to over 30% in recent quarters. So it's been very volatile in those markets. And the Bay Area is an extreme example, but you see a similar story playing out in places like Seattle or even some of the tech heavy secondary markets like Austin or Atlanta, where there has been a higher volume of space placed on the sublease market. There has been more aggressive downsizing in the past couple of years. And because of that, they are a little bit further behind on this recovery trajectory than some of the other more diversified markets like a New York or Dallas in the Sun Belt. So that's one story that's playing out, but there are other markets that are ahead of the curve. So another thing that's really taken place intensely since the pandemic, but even leading into the pandemic, has been migration into the Sun Belt and the Southeast. So there have been individuals moving there who are looking for lower cost of living, higher quality of life, and other amenities that are available in those southern states. And there's also been corporate migration as you've seen those labor pools moving. So a lot of different groups have relocated their headquarters from states like California to Texas or states like New York to Florida. And there have also been other groups who maybe they haven't relocated their headquarters, but they've set up a significant secondary campus in some of these locations. So Sunbelt markets have consistently, since the pandemic began, been ahead of this growth curve where over the past year or so, they're really starting to approach those pre-pandemic levels of activity. Many of them are within 90 to 100% of those levels, whereas the gateway markets and the coastal cities are more in the line of like 70 to 80% recovered with those leasing levels. So there has been an acceleration there that would benefit some of those REITs that are more exposed to those southern markets. And then the other thing that's shaped the recovery is there are certain markets that have been far ahead of the curve in terms of the conversion trend. So that's been a really meaningful shift in supply where the markets that have really incentivized and created new regulation or tax incentives around conversion projects are beginning to see a really meaningful amount of obsolete vacancy removed from their supply. So this is especially true in places like New York or Washington, D.C., where there is now a meaningful volume of buildings being removed from the inventory. And one, that helps to reduce your vacancy rates at a faster rate. But also, there are some tenants that are still occupying some of these buildings that then have to relocate into whatever remains on the office market. So it helps the market at both ends, where you're removing a lot of vacancy, but you're also creating some new demand for the remaining market. So some of the markets that have been more advanced in pushing forward conversions and redevelopments are also moving towards stability a little bit quicker.
Interesting. And Jacob, you've talked about technology, but what about other industries? Are you seeing any particular trends, maybe in financial services or the legal sectors?
Yeah, financial services, obviously, like the other office using sectors, has done some downsizing since the pandemic began. And a lot of that was in line with consolidation strategies from some of the big banks and other large groups within the finance sector, where if they had several offices within a particular metro area, many of them were moving towards consolidating in a single location or in less locations, which usually was in conjunction with a large downsizing of their footprint. So early in the pandemic, finance was responsible for a lot of the downsizing that we were seeing in the market, but they've been a lot quicker to move through that rebalancing period and start to come through into more expansionary strategies. A lot of this is partly due to how advanced they were in leading the RTO push. So many of the big banks like JP Morgan were some of the first to institute hybrid attendance policies, or some of the first to even advance those to stricter policies like 4 to 5 days. And this still continues in 2024. You may recall that earlier in the year, there were some new FINRA regulations that came out, which caused groups like Citibank, Barclays, HSBC to revoke remote work privileges for some of its staff. So they do continue to be one of the most progressive segments of the economy in leading employees back to the office. And that's probably why they've really pushed through these right sizing plans more quickly than other industries. So finance over the past year is back to about 90 to 100% of pre-pandemic activity. And importantly, they really aren't responsible for much of the downsizing that we're seeing in the market today. They have mostly stabilized their footprints and are now entering expansion mode in a lot of markets, especially those Sunbelt markets that we discussed and New York City, which has been very active over the past year. A smaller but also important segment has been legal services. Law firms like finance have been more advanced in returning to the office, and we've seen that translate into more activity. So, law firms have actually been exceeding what their traditional pre pandemic leasing activity levels would be over the past year and are expanding their footprints in many markets. Outside of that, there are some industries that are more advanced or lagging, but they contribute a little less to the overall pie of the office market. One of those groups would be defense companies. So they're a more minor industry within the office using universe. But as we've seen this surge in defense spending over the past couple of years, which is projected to continue into the next administration, that's another segment that's entered growth mode and starting to expand across a lot more markets.
Right. And Jacob, can you talk about what you're seeing when it comes to the performance of these newer, highly amenitized office spaces? Is that segment of the market still seeing the highest demand?
It is still seeing the highest demand, but that segment of the market has probably also seen the most intense shifts over the past couple of years. Since the pandemic began, we've seen a very strong bias for the new construction and the high end, highly amenitized properties. They make up a very small segment of the overall office market. It's about less than 10% of our 5 billion square foot market that was developed in the past decade, but it's seen a lot of the leasing activity over the past few years, about a quarter of the expansionary demand that we've seen in the market. So we've had a pretty robust pipeline up until the last couple of years, which has allowed more new supply delivering and plenty of availability for those tenants who want to relocate. But when interest rates started to increase, we saw our development activity for the office sector come to a halt very quickly. In fact, over the past 12 months, we've seen about 6 million square feet of groundbreakings, which is significantly lower than our previous historical low over a 1 year period, which was about 10 million square feet back in 2009. So we've gone well past our previous historic lows. And now you're reaching a environment where there's very little new supply delivering. There's very little in the pipeline that will deliver, and those vacancy rates are falling very quickly across most markets. So now that those options are thinning, we still see that there's demand for those high-end spaces, but tenants have to consider other options. So now what's happening is that very concentrated activity in the high-end segment is starting to spill over more broadly. We're seeing a couple pockets where it's been concentrated over the past 6 months, and it's largely what you would expect. It's just moving to the next best available supply on the market. So in a lot of areas, that means it's either 2000s or 2010 vintage buildings or a little bit older buildings that have been renovated in the past decade, or there are just highly amenitized, well-located buildings across different ages that are really starting to absorb that demand as new construction fills up. So it's not so much that the nature of demand is shifting, but the nature of what's available is shifting, and they're having to accommodate for that change.
As you say, it doesn't sound like there's going to be any pickup in development in the near term across the sector.
There's a lot of reasons that broadly office development is going to take a long time, probably the longest time out of the major property sectors to recover. And that's largely a consequence of what's going on in the capital markets. So if you look at the universe of capital out there, the trillions of dollars that own and finance commercial real estate in the United States, most of those groups have deprioritized the office sector. It's traditionally been the largest allocation among major property types. But now, since the pandemic and really leading up to the pandemic as well, core capital is starting to deprioritize office in favor of other property types, mainly residential, industrial, and alternatives like single family rental, data centers, life science, other niche property types. So that doesn't mean these groups won't be invested in office in the future, but it does mean that they will be more focused on other property types. So it will be harder to get financing for office development moving forward. But with that said, there's also some indications that some pockets of the market might see development a little bit sooner than expected. So if you look at some different pockets of the country, there are extremely compelling fundamentals in the office market, and it's driving a little bit of better likelihood that you might see development activity. So one example is the Hudson Yards development within Manhattan. Currently, across all of those buildings that have been developed in the past decade, you're seeing about 1% direct vacancy. And a large chunk of that is rumored to be leased up pretty soon. So for all intents and purposes, there will be no vacancy available in Hudson Yards in the near future. And that's a development that has seen near record rental rates for the office component of it as it's leased up. You're seeing similar trends on Brickell Avenue in Miami. As you've seen that corporate migration to the South Florida market, there's very limited high-end supply. And so those vacancy rates have compressed very quickly and rents have grown aggressively. In fact, a Miami office tower signed a record office rent lease this year. It's not true in every city in the US, but in a lot of the major markets, there are these pockets that have seen vast outperformance in recent years and now have very limited supply. So there is potential that you could see some development activity at a more limited scale in those areas, but a broad increase in development across the office market in every major city, CBD and suburban in the United States, that's likely going to be a long time away.
And Jacob, any other trends in the office sector that you're paying attention to right now?
I think one of the most interesting trends is the concentration of vacancy that we see across the market and how that has the potential to transform the market very quickly through conversions and redevelopment. So we've talked a little bit about the flight to quality, but one of the things that's happened as a result of that over the past 5 years is you've had occupiers that are vacating very large chunks of space in older, less amenitized, poorly located buildings as they move to the newer supply. So there are some profiles of submarkets or some building types that have seen a very high rate of this, while others really haven't seen much downsizing at all. So if you look at large scale suburban campuses or urban towers with very large floor plates, a lot of these were developed in the 70s, 80s, and 90s and make up about 30% of the office that's available today. This is where we have the vast majority of downsizing going on over the past few years. So it's left us in a scenario where 10% of the buildings that we track a 40,000 buildings in our inventory. So 4,000 of those buildings comprise more than 60% of the vacant space on the market, which creates problems because the popular narrative around office has been very pessimistic. We have record high vacancy rates. We've had extremely high amounts of negative net absorption. But when tenants are in the market looking for space, they're not experiencing what would appear to be extremely tenant favorable conditions. They're experiencing still rising rental rates and really not as many options as they might expect in the higher end supply. But even though there's this intense bifurcation and this misrepresentation of office in the popular narrative, it does create a lot of potential because now that we have this very active redevelopment and conversion pipeline that's removing buildings from the office inventory, it has the ability to quickly change vacancy rates across many markets. So if you removed about 400 buildings, 1% of what we track, if they were the most vacant buildings in the US, that would bring our overall vacancy rate down from about 22% to 18%, which is about half the increase that's taken place since the pandemic began. So now that you're seeing this activity really accelerate on the redevelopment conversion side, it has the potential to really rapidly shift the dynamics of the office market. So that's one thing that we've been paying attention to a lot over the past few years as we help our clients navigate this discrepancy in the public view of office versus their actual experience. But it now may start to really have a meaningful impact as you see more buildings removed from the inventory over the next few months.
And finally, Jacob, looking ahead, do you see this positive momentum that we've seen lately continuing throughout 2025?
We do. There are definitely some risks in the broader economy, especially as it relates to some of those geopolitical risks, which are by nature unpredictable. But if we look at the US economy, the labor market is in strong position. It's been resilient over the past few years amid the rate hikes and is now projected to grow a little bit more quickly as rates are cut. We're also continuing to see a strong push for employees to return to the office. Obviously, there was the Amazon announcement a few weeks ago, but they're not the only Fortune 100 occupier that has increased their requirements in recent months, and they probably won't be the last, as we saw many tech groups follow suit the last time that they created their policy. So as we continue to see growth in the economy, more groups moving into the office, we are going to continue to drive a stronger recovery in office leasing activity. So we're expecting 10% year over year growth in leasing moving into 2025. And now, of course, the rate cuts will also bring about a recovery in the capital markets. That's been an area that's slower to recover compared to the occupier side. But now that we're seeing those valuations get support and a little bit of more liquidity moving into the market amid these lower rates, you're going to see capital beginning to flow more robustly. And that's going to really help some of these pressures that we've discussed, where there's an oversupply of obsolete space, but an undersupply of amenitized, differentiated space. Because really the only thing that's keeping one office from being amenitized or high quality is a deployment of capital. So as that improves, it's going to give some positive feedback into the occupier market as well.
Great. Jacob, thank you so much. This has been really interesting.
Thank you.
And if you enjoyed this episode, please leave a review or subscribe on your favorite podcast platform.